Welcome everyone. I'm not sure how many of you are out there because I can't see all the numbers, but this is the first EP&T webinar, so I'm quite excited actually to be able to bring our annual results to shareholders and other parties that are online. Be something that we'll do a bit more of this year. It's probably something that we've neglected in the past, being more accessible to our shareholders, and so I hope you do find this useful. And look forward to speaking to you afterwards for those shareholders that want to reach out. It'd be great to hear the feedback. Couple of pages of important notices. I'm not going to dwell on them. They're in their investor deck, and really just put them there to tell you that it's all care and as much responsibility as we're able to provide you. For most of us that know our business, we've done a lot of work in the last 18 months to really try to make our business as simple and as clean as possible to understand. Building optimization, building efficiency are not easy terms for people to get their head around because there's a lot in the industry. But hopefully, as we walk through this afternoon, we've tried to make it as simple as possible for all of you to understand our business. Firstly, just a quick corporate snapshot. A few things to call out. One, I really love the fact that board and management, me inclusive, have shares in our business. Management has about 8% of the share registry, together with directors, which includes myself and Patrick, together with institutional, which we think is relatively unique for a small company like ours in the exchange. Reasonably good institutional support. And following, given where the company has come from over the last sort of 3.5 to 4 years since IPO. So for me, that's a really important measure and alignment with our institutional and other shareholders. Our share price, I know a lot of you have asked me about this when you meet me and when you see me. Not much I can do about that. I wish I could do more on it. I think we're significantly undervalued as an entity. But I guess it's what are we doing about it? And that to me is the more important thing. This presentation is a start. It's more an investor journey. We need to get the message out to our investor base and others to tell them how good we are as a business, I think, and how we are performing. So that's one thing. And I think the other element is having more access to our business. So we have engaged with Evie and her firm. So we'll be doing a few more industrial relations, investor relations type activities, I guess, over the coming months. So who are we? I won't dwell on the words on the page, but fundamentally, we are a building optimization business. And the business that we're in really is not just about energy saving, but it is a key element of energy. It is a key element of what we do. We've got proprietary technology, which is quite unique for our business because a lot of our competitors do distribute third-party tech. We've got our own. And we've got approaching 550 sites now globally in over 25 countries, capturing 15-minute data every day, every week, every month, every year, which equates to about 5.5 billion data points per annum. And that is quite unique for a business of our size. From my perspective, I think that our business is quite unique. It's in a really good, strong market right now, and it provides something really sticky for our customers, which you'll see later on. Who's behind the business? I guess the board and management. And we have had some key board changes this year. We did have a replenishment of the board. Paul and Elizabeth, who are two, I believe, quite high-profile, very experienced directors, joined us, which was quite humbling. And they do bring additional capability that we needed to our board. It supplements Victor's capability, very renowned business and property investor out of Europe. And of course, leading the management team, there's myself and Patrick, our CFO.
A majority independent board as well too, which is very important.
And for the first time ever, we are majority independent. Yep, 3 non-executive directors, 1 executive director only. So to me, I think that's the right balance for the size of business that we are. Company overview, a couple of things to call out. One is our blue chip customer base. One of the things we don't do enough of, and we should, but we are always cautious with our customers, is we've got some of the biggest logos on the planet. And I don't say that lightly. The fact that we do represent some of these companies in multiple jurisdictions around the globe is one of our unique selling propositions of the business. We have 25 countries now that we have installation partners with, and therefore it makes us quite attractive to property owners that have multiple property types, commercial real estate, retail, hotel and industrial, as well as in multiple jurisdictions. The market, you know, I do get a lot of questions about the market we play in and the macro environment that we play in. A macro environment is in the BMS, more specifically in the BEMS market. It's approximately a $6 billion market globally, and we have roughly $16 million of contract value in it. So our ability to grow in that market, in my view, is quite substantial. And it's part of the business transformation that we're making to make this company more sustainable and able to grow more rapidly. And a third call out for me in terms of our core capability and what we do well is our ability to deliver proven energy savings. On average, over the life of the business, we are doing around 21%. There's some data points in our presentation around what we did in the last 12 months, which is bordering on the 21%. But more importantly, a number we don't make widely available to the industry is at present, we're effectively delivering over 50 million Aussie dollars in savings per annum to our customers. And later in the presentation, I'll talk to you a little about what that looks like in practical terms. So I think we've got the right business in the right industry doing the right things. It's now around execution. And I think in FY24, we did show a glimpse of what we can do when management's really focused with some, achievable targets. We'll go into the detailed operational numbers shortly. Patrick will take us through that. But the call outs for me this year is number one, over 25%, close to 28% growth in our annual recurring revenue. For me is quite attractive, particularly some of the challenges we've had in the business, which I've been very open about historically for those that have been following our business for a while, particularly around our installation process, where we had some challenges in 23. We've overcome those challenges and have shown again, 28% growth in annual recurring revenue at the same time as reducing our operational cost base, resulting in an EBITDA loss. Again, not my ideal situation, but far better than where we were this time last year, down to around a $1.4 million loss. So to me, they're the two outstanding numbers this year that we point to. Our management of cash has also been really good. I was hoping to have that as close to zero as possible. Again, is something I harp on about. We got within $200,000. So we did fail a bit, but I think overall, over a 90% reduction in our cost, in our cash consumption in running the business is a really strong measure. What does our tech look like and how do we do it? I won't dwell a lot on these next two slides around our edge intelligence system, but again, for any interested parties on the call today or investors that are not yet invested in our stock, our architecture, one of the big call outs for us is we connect to more than just the BMS. For us, one of the things that we are very passionate about in the business, and that's all of our employees, every one of them, and I know pretty much all 69 of our employees, is they're all absolutely focused on accuracy. Without accuracy in our business, we have a real issue because we actually guarantee, we have a product, which is a very large product in our business, guarantee the savings outcome. So unless we can prove it, we can't claim it. And our customers continuously remind us of that. And so for us, the core element of our business is built on accuracy. Everything we do, we look to make sure we can get complete data, accurate data, because that's what drives changes in a building. And that's what a lot of our competitors, in my view, don't do as well as us, is that ability to deliver consistently accuracy in the data that's coming from the building. To do that, we go beyond just energy. The company's core business started in metering analytics, but over the last few years, we're now able to ingest all forms of data through the Edge platform via our memory module. And that blue box you see in the middle of your screen is our proprietary tech. That's where the data passes through. It gets captured. It gets thrown through our Edge analytics platform. It gets scraped for inaccuracies, and then it gets delivered to our customers in a way that they can do something with it. And again, that's an important part of the journey they take with us. The outcome, the applications we've therefore got hanging off that, three simple forms. We collect it, we analyse it, and we deliver it. One of the big call-outs for me is, again, part of our unique model here is the curated action service that we provide through our customer delivery team globally. For us, buildings now are managed by people other than engineers. Historically, a lot of commercial real estate were being managed and maintained by engineers. These days, because of the change in the tenancy profiles of a lot of buildings, there's more management of tenants than there is management of the building. And the building manager relies on a lot of technical people to make sure the building is operating optimally. One of the things we do is we employ engineers that actually understand buildings. And so when we send alerts to the building manager, if they are not appropriately engineeringly qualified and may not know exactly what to do, we help them do that. And for us, that's another part of our unique proposition to the market, which again leads to our ability to grow with our customers and provides an element of stickiness in our business model. A good example of that is, and I always use this slide, and again, for those that know this, I apologise, I'll show it again. This slide is very powerful to me because it's a really interesting data point. So the brown that you see on your screen is essentially where the building was operating with a fairly sophisticated BMS system in this building. That was seen as optimal, that was seen as normal. There didn't seem to be an issue by the building manager or the asset owner at the time. We installed our service, technology and service, and where we got the building were the blue lines. And the blue lines effectively were saying that this was just a normal commercial real estate building. It was an office tower. It should be operating traditionally between, sort of 6 a.m. to about 6 p.m. With loads of electricity going up to about the middle of the day, and then of course loads coming down by the end of the day. This little example for us was very powerful. There were other technologies in the building at the time, but they didn't pick this basic operating inefficiency in the building. The outcome of this is we save the customer a whole lot of money, but also save the customer a whole lot of CO2 as well. So for me, our tech does more than just give inefficient readings. It also helps the building manager optimise and do their job much better. Over the last 12 months, we've also looked at how we've gone to market. I think our product was very cumbersome. It was a bit clunky. On the next slide, you'll see how we've streamlined our product suite. We're continuing to streamline that. We've now introduced Edge Certified, which will soon launch through a product suite as well. And there's another iteration of our product suite. We're evolving our product suite to make it very, very simple for customers. The product suite also gives us an opportunity to get into customers earlier, and also help them on their journeys to net zero, because customers have different requirements as they go down the net zero journey, from the very start of the journey, which is, can you tell me how much energy I'm consuming and CO2, to all the way to the end of the journey is, I'd like you to help me now identify maintenance issues that I can improve, and also give me earlier alerts to faults in our mechanical and electrical equipment in the building. And so part of our product evolution is to provide that whole suite of services to the customer. Some of that will be through internal development, and some of it will be through acquisition. So the old buy and sell, which I'll talk a bit more about, sort of where we're going to next as a business near the end of this presentation, is something very firm in our mind. What do savings look like? Again, sort of 21% on average. We try to break it down very simply for those of you that are good travellers. Given the savings we have to date, which is over 500 million tonnes of CO2, one of our goals, which you'll see more that we will talk about over the coming months and years, is trying to reach 1 million tonnes of CO2 saved globally. We think that for us is quite a unique part that our business can do to contribute to not only our customers' net zero journey, but globally as a human race, where we think we want to get to in lowering our overall CO2s. That's the equivalent of at least what we've saved to date for people: 21,000 trips, Sydney, London, return. So if somebody can envision themselves doing that 21,000 times, that's effectively what we've saved in CO2 today. As at 30 June, we're now being able to get more dedicated and detailed data around this. Our commercial office portfolio saves around 21%. Our hotels, which is a new vertical that we entered into only a few years ago, which we're now is roughly around 30% of our business today, saving on average at present over the last 12 months around 15%, and our retail portfolio is averaging around 17%. So these are quite large numbers, particularly as we believe energy prices will stay consistently high over the foreseeable future. Some case studies for us. We're very proud to be partnered with Westfield in London. It is one of the largest shopping centres in Europe. We've been partnering with them now for quite a while, and this is a small snapshot of what we've been able to achieve on that site, which for us, we're quite humbled with, because we're saving not only money for Westfield London, but also giving them a very good ESG profile, given the tons that we were able to help them and assist them to save. Another case study is a local major hotel in Sydney here. Again, we've been partnering with them for quite a while, a very sticky customer, and you can see there how we've been able to save not only dollars, but again, quite a few thousand tonnes of CO2 for them over the years. And these are real case studies with very measurable outcomes. Our global profile now is in 547 sites, 25 countries. We've been growing that steadily over the last few years. And one of the things that I'm really pleased about is, even though our number of sites has slowed a bit in terms of the number of sites that we have put on over the last few years, the average dollar per site in terms of ACV and ARR has been growing. And so for me, it's quite powerful, particularly in a market where we are seeing a lot of smaller competitors trying to get in and putting their new system, which not a lot is proprietary. So I'm really pleased about that. We've also got some numbers there in the customer base about where our geographical split sits. Over 70% now of our market is offshore. And in terms of the verticals, our large verticals sit in commercial office, hotel, and in retail. And you'll be able to see that on your customer base slide. Might have a bit of a delay between my talking and the slide coming up. Overall, we've got really sticky customers, I believe. Average life of customer at the moment, based on our current customer base, is about just over 4 years. And to me, that's quite a powerful testament in how our customers not only perceive our technology and our service, but the benefits that they get out of using our tech. I'd like to hand over to Patrick now, and he'll take us through the financial results for FY24.
Thank you, John, and good afternoon, everyone. Revenue and EBITDA. It's very pleasing to be able to highlight to you all that total revenue is up 23% this financial year, and it's starting to show the benefits of the hard work put in over the last 18 months to really transform this business and get it on a strong footing. I'll talk about recurring revenue in the next slide, but that is also up as well too. But EBITDA minus 1.4 million underlying is a 71% reduction from the prior year. So again, really sort of highlighting that as we've grown our revenues, we've also been able to manage our cost base very strongly. And again, I'll deal to that shortly. And that underlying EBITDA of 1.4 negative is 3.5 million below what it was the prior year, and 5.1 million below what it was in 22. So really quite a big turnaround in the performance of the business from an EBITDA perspective. Looking specifically at revenue, you'll see that recurring revenue is up 28% in the year. This is one of the key features of our transformation, is growing that recurring revenue base. You'll see on those slides on the chart there that recurring revenue is up 131% since FY21 and double what it was only 2 years ago. So really, we're making some very strong strides in that area. Important part of our business, and of course, as that is our fundamental part of our model, recurring revenue will always be the lion's share of our revenue line compared to project revenue. Project revenue is very much optimistic. Generally, it's tenant billing and things like that are one-off. They do tend to come up each year, but not recurring. So you'll see that number sort of sit between the 0.6 and the 1.1 million each year. The second key highlight from our business transformation is the impact on the business efficiency side. So we've been able to grow recurring revenue at 28%, but then keep operating expenses down at 6%, reducing them by 6%. Again, that highlights a real focus that the business has had on efficiency and how to get more from what we have. It's very pleasing to see that employee costs, which are the lion's share of our expenses, that they are also down 5% on the year. So not only have we been able to sell more, we've been able to achieve more, but we've done it at the same cost base, if not a little bit less. So again, real focus on the efficiency and how we can actually utilise our resources better and get more out of what we've got. Operating cash flow, as John highlighted, we would have loved it to have been positive. We got very close. As can happen at these times, a couple of key customers like to hold off their cash around year end and pay soon after, but that's just the world in which we live. But very pleasing at the gains that have been made in cash flow. And in fact, collections are up 27%, which is actually ahead of the 23% growth in overall revenue. So look, we focus very much on collections. Some markets are harder than others. The Middle East always pay longer terms than the rest of the world, but we keep on top of them, and the money always does come in. Payments to suppliers, 15.9 million, down 7%. Again, this again shows and hopefully draws attention to the tight working capital control that we've exhibited over the last 12 and 18 months. That, you know, we very much have a system whereby we need to match outflows with inflows. Okay, so it's very important for our business and the sustainability of our business to really manage that process very tightly, and it's a credit to EP&T and the team for doing that. Other cash flow items, we've got project installations. The efficiencies there, you'll see that the reduction in the spend on investing is significant for this business, and that again really highlights the focus we've had on getting installations done within our 90-day time frame. It's a great thermometer of just how well the business is performing, and if we can stick to the 90-day time frame, then we install all of our projects very efficiently. And you will note we did have a capital raising during the year.
Sorry, Patrick, I just want to say just on that in terms of our installation, because it was a focus area of ours in 2023 and a big part of 24. A chart that's not in our deck this year, which you know, shareholders should be aware of, is our backlog at ACV. It's something that we focus on and we look at monthly. As at FY24, it was 16%. A large part of that is based on when we win new ACV and our ability to install it quicker. That compares to 19% last year in 2023, so we brought it down again, and it was at as high as 51% between 21 and 22. So half our ACV was not installed. So we brought that down quite significantly over the last 3 years.
Thanks, John. And then the last slide I want to take you through is about our operational efficiency, and a couple of charts here that are really worth looking at. The first one, the orange line, sort of highlights the ACV to FTE, and that continues to strengthen. And just a reminder, ACV is our annual contracted value. It's either just been won or it's fully installed and up and running. So it's a total available revenue. And that per FTE has continued to increase, and it is another highlight of our focus on efficiency and winning and focusing our sales team, focusing the employees on delivering what we have. The second chart is employee expenses as a percentage of ARR, and the real highlight on this slide is there has been continual improvement. But if you look at FY24, this is the first time that our annual recurring revenue, so that's the revenue we're now billing. So it's part of the ACV, but it's where it's been installed and we're now issuing monthly or quarterly invoices for, has now exceeded employee costs for the first time. And that's going to be really important, because by having that, and you'll recall that I mentioned that employee costs are the lion's share of our operating expenses, by being able to hit that threshold and continue to improve, then what we'll see is more ARR flowing down to the bottom line, which is great news for EP&T and of course the shareholders' returns. With that, now I'll hand this back to you, John. Thank you.
Thank you, Patrick. So what next? For us, there are really 3 areas that we're focused on right now. This has got 4 boxes, but it's really 3 areas. One's around our organic sales and market growth. Very much for us now, it's having turned the business around, having right-sized the cost base. Might be a little bit more there, but by and large, we've right-sized the cost base. Having pointed the company in the right direction, I feel over the FY24 year, our focus now is all around sales growth and getting that ACV growth number, which this year was around 11 to 12%, a lot higher than that, back to sort of our historical growth rates of 18 to 20%, which is where we'd like to be. Last year, rightly or wrongly, I made the call to dampen ACV growth because we were losing money on both ends. We were losing money trying to find the business as well as installing the business. So we had to make a call. It was a difficult call, and I understand a lot of shareholders probably felt we're not growing as well as we should or could. And I think part of that is right, but part of it was also a needed piece of medicine that the business needed to take to turn around. But now having done that, we are really focused on our go-to-market strategy, predominantly with existing customers. One of the things I'm quite pleased about and very proud of in this business, and that's all the good people other than me that do this every single day in our company, is really servicing our existing customers. As I said, they are blue chip, they're in multiple jurisdictions, and they have multiple asset classes. And so for us, our ability to expand our product across different property types, which is not easy, and a lot of our competitors do struggle, we are at this point able to do that, as you've seen by our composition of our verticals. For us over the next 12 months is focus with them to grow with them in the markets they're in. And so for us, the UK, European market is a big market for us to invest in, Australia and clearly the Middle East, where we're able to find the right partners to grow with, given some of the challenges on debt recovery in that market. So, and we're very open about these things as a business. The second part of our focus for FY25 as a board and management is around innovating our product. The product does need to grow, it needs investment, and we're very thankful we have a new head of product in our business. We've just recently signed off on our product roadmap, and we're in the process of implementing that roadmap as quick as we can. And so for us, rolling out some new products with our customers to continue their journey, to help them on their journey of net zero is a second focus area. And the last one, and I say this very openly as well, is M&A. We're a company in the public markets. We've got some good institutional investors, and I think we've got some good support, albeit wouldn't mind seeing a share price grow a bit, which we'll work on over the next few months. But what we are seeing is we're starting to see valuation metrics come back in the private markets. There's a lot of down rounds, in my view, of equity raisings in those markets, and I think founders in those markets that may have either product functionality that we really like in order to expand our function, and or a vertical area that we would like to enter into with our product, are the two areas that we're focused on. And so we are seeing some opportunity for us to have a look at some really interesting businesses in that space, and we'll continue to look at those as part of our FY25 focus areas. Overall, I think, at least as much as I can say, I think, you know, our business has taken a journey. It's gone through a valley, which I believe we have come out of. And for that, I'm very humbled and thankful, not only to our staff who have played a massive journey in getting us there, but also our shareholders. For those of you that are on the line, I do thank you for that. You've persevered with the business and have supported the business through that journey. And I think a lot of the hard work of that restructuring is now behind us, and we can start thinking about a bit more blue sky. And we're doing it in an environment where our product is still sellable. Our energy optimization and savings are still relevant. We're still delivering 21% on average across the board. We're still helping our customers reduce significant amounts of not only cost, but CO2. And we're doing it in a market that I believe is just growing, and will continue to grow as ESG is driven both by commercial good sense, but also legal and political levers that are being used by countries around the world. So for us, I think we're primed, we're in a good space, and I think that FY25 should be, from what we're seeing at the moment, a reasonably upbeat time of the year for the business. Thank you, and I'm happy to take, Patrick and I are happy and open to take any questions.
Thank you so much, John and Patrick. That was great. It was very thorough. I actually have a question, and there's a few others that have come through as well. Just when because I'm new to this platform, when the Edge product is installed at your customer's premises, how quickly how quickly does the data collection show where the customers can start, applying some cost savings?
Yeah, so I think I got the question right. So the time to install, we call, has about 90 days from when the customer signs the contract to when we switch it on. The switching on includes what we call commissioning. So we spend 2 weeks commissioning the system to make sure that it's integrated with the building. We can see all of the metrics that we need to see in the building that have been contracted to with the customer. And during that period of time, we're looking at whether the building is performing in accordance with the baseline that we had set on the with the customer. So long as we can do that within the 2 weeks, and almost 90% of the time we can, sometimes we can't, we switch it on, things aren't working, things might not be quite as we wanted them to be. Typically, we can start delivering savings literally the next day.
Wow, that's amazing.
So it's quite quick in most circumstances, but there are some circumstances that clearly we can't do that.
Yeah, okay. Fantastic. So there's been a question that's come through. So I'm just reading this. So 551 building sites in January, yet 547 sites at 30th of June. What drove this?
Yeah, so as at 31 December, we had 551 sites, 547. A couple of things we do have in our business, roughly or about somewhere in the order of 2 to 3% churn, net churn. So even though the building numbers came down, our ACV and ARR went up because we're growing either with our existing customers. So when they renew, we can charge them more, or we've added buildings at an average ARR higher than what we lost. So our revenue keeps going up, but the number of sites as we count has net gone down.